Welcome to StockTok's deep dive into Colgate-Palmolive Company. Colgate-Palmolive is one of the world's largest consumer goods companies, manufacturing and marketing oral care, personal care, home care, and pet nutrition products across more than 200 countries. At the time of recording, the stock is trading at 85.81, sitting in the lower half of its 52-week range, which runs from 74.55 on the downside to 99.33 on the upside. The RSI, or Relative Strength Index, a momentum gauge where readings above 70 signal overbought conditions and below 30 signal oversold, sits at 48.6, squarely neutral. The 50-day moving average of 90.18 sits above the current price, while the 200-day moving average of 83.6 sits below it. That tells us the stock is in a near-term downtrend relative to its medium-term trend, but remains above its longer-term baseline. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Colgate-Palmolive's core revenue engine is its oral care franchise. Brands like Colgate toothpaste command significant shelf space in both developed and emerging markets, giving the company durable pricing power rooted in brand recognition and consumer habit. The StockTok score for Colgate-Palmolive comes in at 45 out of 100, a caution signal. Breaking that down across 5 dimensions: valuation scores 0 out of 20, financial health scores 14 out of 20, profitability scores 17 out of 20, growth scores 6 out of 20, and smart money scores 8 out of 20. Strength in profitability, but real questions around valuation and growth momentum. Now, valuation. The question every investor has to answer: are you paying the right price? The trailing price to earnings ratio, what you pay today for each dollar of last 12 months' earnings, stands at 32.75 times. That is a meaningful premium for a mature consumer staples company. The PEG ratio, which adjusts the price to earnings multiple for expected earnings growth, and where readings above 2 begin to signal overvaluation, comes in at an elevated 8.94. That is a significant red flag, in our view. The EV to EBITDA multiple, enterprise value divided by earnings before interest, taxes, depreciation, and amortization, a capital structure neutral valuation tool, registers at 19.31 times, which runs ahead of where the consumer defensive sector has historically traded. In terms of competitive moat, Colgate-Palmolive benefits from deep intangible assets, decades of brand equity, distribution reach, and consumer habit formation that are genuinely difficult to replicate. Guru Focus Value, a proprietary intrinsic value estimate, stands at 91.88 at the time of recording, implying a margin of safety, the discount to intrinsic value of 6.62%. That is a thin but real discount. Wall Street analysts at the time of recording have a consensus mean target of 95 across 19 analysts, with a high target of 105 and a low of 79. The overall recommendation is buy. The next earnings report is due May 1st of next year, with the street expecting earnings per share of approximately 0.94. That is a near-term catalyst worth monitoring. Market sentiment around Colgate-Palmolive as of the creation of this video leans neutral, with insufficient recent news flow to shift the dial in either direction. On balance, the valuation setup warrants caution, in our opinion. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist of profitability signals, balance sheet improvements, and operating efficiency, comes in at 6 out of 9 for Colgate-Palmolive. Scores of 6 and above are generally considered healthy, suggesting the business is passing the majority of fundamental quality tests. The Altman Z-score, a multi-factor model designed to assess the probability of financial distress, where scores above 3 are considered safe, registers at 6.70. That is a comfortable reading and suggests the company faces negligible near-term bankruptcy risk. Now, where the picture gets more complicated is the capital structure. The cash-to-debt ratio of 0.15 is low, meaning for every dollar of debt on the balance sheet, the company holds only 15 cents in cash. That is a tight liquidity buffer. The current ratio, current assets divided by current liabilities, a measure of short-term obligations coverage, stands at 0.83, which falls below the 1.0 threshold typically considered comfortable. However, the interest coverage ratio, how many times operating earnings cover interest expense, is a robust 15.8 times, indicating the company has no near-term difficulty servicing its debt. The debt-to-equity ratio of 158.41 reflects aggressive use of leverage, a legacy of years of share buybacks. The foundation is serviceable in our view, but not fortress quality. Next up, profitability. Is this business actually making money efficiently? Let us start with return on invested capital, which measures how effectively management deploys every dollar of invested capital to generate returns, and where readings consistently above 10% are considered strong. Colgate-Palmolive's return on invested capital stands at 25.30%. That is an exceptional figure, and is perhaps the single most compelling data point in this entire analysis. It tells us that management has demonstrated a durable ability to generate outsized returns on the capital it deploys. Moving down the margin stack, gross margin, revenue minus cost of goods sold as a percentage of revenue, sits at 60.11%. That is a wide margin for a consumer packaged goods company and reflects genuine pricing power. Operating margin, which captures the profitability of core business operations before interest and taxes, comes in at 20.77% again, well above sector averages. Net margin, the bottom line after all costs, stands at 10.46%. And free cash flow margin, free cash flow as a percentage of revenue, which tells us how much of each dollar of sales the company actually converts to cash it can deploy, registers at 17.83%. That is a meaningful number. It means the company generates substantial distributable cash, which supports the dividend and buyback program. The profitability profile here, in our view, is genuinely best in class for the sector. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, Colgate-Palmolive has delivered revenue growth of 4.30% per annum. Extending the lens to the trailing 5 years, that figure improves slightly to 5.80% annually. That tells us growth has actually been decelerating in the more recent window relative to the longer-term average, a pattern that deserves attention. For a consumer staples company with global scale, mid-single-digit revenue growth is neither alarming nor exciting. It is broadly in line with what the category allows. The more concerning data point in our view is book value growth over the trailing 3 years, which comes in at negative 48.20%. Book value per share, the net assets attributable to shareholders on a per-share basis, has been shrinking dramatically. This is largely a mathematical consequence of aggressive share buybacks financed by debt, which compresses equity on the balance sheet. It does not necessarily reflect operational deterioration, but it does mean the company has very little equity cushion and leaves less room for strategic error. On the income side, the dividend yield at the time of recording stands at 2.42%. For income-oriented investors, that represents a modest but reliable yield backed by strong free cash flow generation. The growth thesis here, however, is not compelling on its own. The data suggests this is a business growing at the pace of its markets rather than taking significant share. That warrants a measured view on the growth dimension. Now let's talk smart money. What institutional capital is actually doing with this name? 19 top-tier guru investors currently hold positions in Colgate-Palmolive. That is meaningful name recognition at the institutional level. Among the notable holders, First Eagle Investment Management, a firm known for its disciplined value orientation, holds Colgate-Palmolive at 1.10% of its portfolio and has been adding to its position. Yakman Asset Management, another well-regarded value shop, holds the name at 0.87% of its portfolio, though it has been reducing its exposure. Jensen Investment Management, which focuses on quality compounders, holds the name at 0.15% of its portfolio and has also been trimming. When we look at the 13F filing data, the quarterly disclosures institutional managers with over 100 million in assets are required to file with the SEC. Only 9.1% of filers are net buyers of Colgate-Palmolive. A reading above 50% would indicate broad institutional accumulation. The current reading suggests the weight of institutional money is either holding steady or reducing exposure rather than building new positions. Insider ownership stands at 1.64%, which is low. Management owns very little of the company they run, which can be interpreted as limited alignment with shareholder outcomes. And in the most recent 3-month window, insiders have filed 0 purchases against 7 sales. That is a clear directional signal from people with the most direct knowledge of the business, not a buy signal. In our view, the smart money picture warrants caution. Guru holders are present but trimming. Institutional buyers are a small minority, and insiders are selling. And finally, the verdict. Let's bring it all together. On valuation, the setup looks stretched to us. A trailing price-to-earnings ratio above 32 times, a PEG ratio approaching 9, and only a thin margin of safety to Guru focus value all suggest you are paying a full price for a mature business. On financial strength, the company earns a passing grade. The Altman Z-score is safe, interest coverage is robust, but the leverage profile and below 1 current ratio keep this from being a fortress balance sheet. On profitability, this is where Colgate-Palmolive genuinely shines. A return on invested capital of 25%, gross margins above 60%, and a strong free cash flow margin make this one of the better operators in the consumer sector. On growth, the trajectory is modest and decelerating, with book value declining sharply over 3 years, not a business where growth alone drives the thesis. On smart money, the signal is cautionary. Institutional buyers are a small minority. Insiders have been net sellers, and several prominent Guru holders have been reducing positions. Taken together, the StockTok score of 45 out of 100 reflects a business of genuine quality, operating in a difficult valuation environment with limited near-term catalysts. One might argue the case for a long-term position if the price were to move meaningfully lower, but at the time of recording, the risk-adjusted setup warrants patience rather than urgency. In our view, everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on Colgate-Palmolive Company. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.